have an eye on this
Okay, I think we can start. Robert? Yeah, okay. Okay, then I'll share my screen. Okay, welcome back to the guest lecture, to our third guest lecture today. And yeah, this time we're going to talk about multiple valuation, about multiples. Yeah, that in the last two sessions we discussed basically cash flow forecasting using a business plan and cost of capital, which are, yeah, the first one is also important for multiples, the business plan. Cost of capital more important for DCF valuation, for the absolute valuation, and this time we talk about relative valuation. And yeah, to give you, we start with a short introduction, and then we discuss different types of multiples. And then we go into more details regarding trading, transaction multiples, trailing forward multiples, and also some yeah, specific topics regarding differences in growth and profitability and how to account for that in a multiples valuation, and give you some practical considerations in the end. Okay, then let's start with a short introduction. You see here, not all, but most of the different valuation techniques, and I think you should be familiar with most of them, especially on the left-hand side, where we have our, yeah, let's call them value approaches. And on the right-hand side, we have basically more market price-based valuation techniques. So on the left-hand side, we have value-based ones, on the right-hand side, price-based ones. And well, the value-based ones, yeah, we discussed in the last sessions, and you also discussed them with Professor Deng. Yeah, basically, its income approach is the most prominent one. Income approach with the two yeah, different methods: entity method, equity method. And then within these methods, you have also like different approaches: APV, adjusted present value approach, WACC approach, for the entity method, and for the equity method, you have flow to equity or DDM approach, for example. There's another approach which we are not going to discuss in detail, the cost-based approach. The cost-based approach is a bit different. It basically measures how much or how high are replacement costs, for example, for a company. If you have a company and you want to build that same company, how much are the replacement costs you need? Or, for example, if you want to liquidate a company, then it's more like a liquidation value. If you sell all the assets a company has, all the machines, all the property, and so on, and then basically what's left is then the liquidation value. And these are cost-based approaches, but yeah, we're not going to discuss them in more detail. And on the right-hand side, you have the price-based approaches. The first one would be just quoted price. If you have a stock listed company, publicly listed company, then you have a price. You have a stock price. So you really have a quoted market price, and then basically you can assume that the market price of your company equals the value of your company, for example. It's a price, but you can use it as a value reference, for example. Or what you can also do is you could use multiples. Multiples are also price-based, and there you also have a distinction between entity and equity multiples. For example, the EV sales, entity value to sales multiple, EV EBITDA, and so on. And this means if you don't have the quoted price, then you could use, for example, the EV sales multiple of your peers. So you have a peer group, and then you basically calculate multiples for your peers, your public listed peers. So you calculate, for example, EV sales multiple and apply to your company, but we will get to that. And of course, if you are publicly listed, you already have a multiple. So if I am a publicly listed company, then I can just use my sales figure and calculate the EV sales multiple based on my entity value, my own company's entity value. So yeah, these are basically the different valuation techniques, the value-based and price-based techniques. And now what's maybe important here is to really, again, differentiate between what's price and what's value. There's quite famous quote by Warren Buffett, or actually was by Benjamin Graham. It's like Warren Buffett's mentor, but that price is what you pay and value is what you get. And what it means is price is really it's somehow subjective. You pay a certain price for a certain good, and the value you attach to that good or that company could be quite different. And in terms of a transaction or for valuation purposes, what we mean by that is this price is in this sense objective. Market price, for example, market price is basically the weighted price, all the weighted subjective prices of all the market participants come together in one like market price. So therefore, it's somehow objective. But on the other hand, prices also reflect non-financial motives and current market sentiments. If you think about so-called market bubbles, for example, or market crisis and so on, their behavioral aspects play more important role sometimes than we would expect, or and that means prices could be distorted and could be very different to underlying asset values, for example. But nevertheless, price is really very observable. So typically in evaluation, if there is a market price, we would have to consider that in some way. And with value, the idea is more to estimate really the underlying value of the asset based on risk and return characteristics, as we discussed in the last sessions. So risk with your cost of capital, return with your business plan, for example, and then based on your cash flows, your cost of capital, you would then really calculate the underlying value, or we would expect that this is then really the underlying value of the business. But also the valuation is always dependent on the person doing the valuation, meaning there are also like subjective assumptions in there and so on. So that's could be a bit, could also be like distorting that valuations are performed by different also market participants with different objectives, and they incorporate their own subjective assumptions in that. So that's basically what we're in between the really value-based and price-based valuation techniques. And we talk today about the price-based ones, multiples. And here again, you can see basically this more or less the same picture as we discussed on the slide before. You have your underlying objective asset value, which is here the dark blue line. And then you have your market prices, which fluctuates around this intrinsic value. So that's what you can that's a typical picture you would have if you observe market prices and calculate your DCF, for example. Then market prices will fluctuate around that DCF value. Okay. And what are multiples? Again, multiples are market price or price-based figures. Price-based is a price-based valuation technique, and for that you would use, for example, if you value a company which is not publicly traded, or even if it's publicly traded, and you decide to use a peer group for valuation, then you would form a peer group in the first step, and then you could calculate multiples for your peers. For example, you have your market price, and then or your enterprise value, and then you have a reference value, which is, for example, a revenue or EBIT, and then a multiple is basically a relation between those two. So you say, for example, if I have sales of 1 million, I have a market value of 3 million, then the multiple is 3, the EV sales multiple. So it's just a relation between two different reference values. And then you apply that same multiple to your company with a different reference value, with a different EBIT, your own EBIT, for example, or your own revenue figure. And so you come up with your company's business value. And what's very important here, the multiple valuation is a one-period model, and therefore it assumes a sustainable reference value. And what that means is that if you have a startup company, for example, with negative EBIT in the first year, then you cannot really apply an EBIT multiple. If you have very low sales figures and you expect to have high growth over the next years, then also the sales figure of your company is not really sustainable. So we're always looking really for sustainable financials here. So that's really important here. It's basically equivalent to the terminal value in the DCF valuation. In a terminal value, we also assume sustainable revenue level, sustainable profitability levels, and with that we go basically into eternity. And that's what the multiple also does. So you cannot really grasp that, for example, if you're not in a sustainable situation now, then it's quite hard to incorporate that in a multiple valuation. But you could also like assume that for example, for a DCF, you have a sustainable EBIT level, you have a sustainable revenue level. You could just assume then that these are also usable for the multiples valuation. And what's also here important, yeah, I think the other points you can go through them on your own, and we have here some typical considerations in multiple valuations, and I think we are going to address most of these questions in the guest lecture. Yeah, so we discuss types of multiples, entity equity multiples, and so on. So I'll start with the types of valuation multiples first. I briefly mentioned that we have entity and equity multiples, and yeah, that's a very important distinction, because the entity value multiples basically refer to your company's entity value, whereas the equity value multiples directly refer to the equity value. And yeah, the most prominent entity value multiples, for example, EV sales, EV EBITDA, EV EBIT. Yeah, there's also like EV free cash flow multiple. But I think the first three multiples are the most commonly used entity value multiples. And on the equity side, you have, for example, the price to sales ratio, PE multiple. The PE multiple is also very common. The PB, price to book value multiple, also. There's also like price earnings ratio to growth, which is a combination of the PE and the growth rate. And I think this picture is a bit more eluding. You have here, for example, the P&L, typical P&L. And here you can see that the entity multiples refer basically to the top of your P&L, whereas the equity multiples directly go to your net income. Yeah, that means, for example, if you start in your P&L, the sales revenues directly go to the EV sales multiple, and that's good. For example, if your profitability levels are not really sustainable yet, if you are a startup, for example, with very high costs and negative operating results, for example, then you cannot use, for example, EBITDA multiple. It's just not possible. It would be negative, wouldn't make any sense. You could, in this case, use sales multiples, for example. So in valuing startups, EV sales multiples are very common. In most other valuations, I would argue that EBITDA multiple or EBIT multiple would make more sense, because if you deduct from your sales all of your costs, your operating costs, then you have your EBITDA, then you already incorporated the profitability level of your company. Meaning, if you have two companies with the same revenues, and totally different EBITDAs, then one company is more profitable than the other company. So if you apply EBITDA multiples to your EBITDA of your company, then you really incorporate the profitability metric in your multiples. Whereas with sales, you don't incorporate that. It doesn't matter really. And in the end, what's important in evaluation is really profitability, right? So sales is important, but not as important as really what you can get out of your company in terms of dividends, in terms of cash flows whatsoever. And as a proxy for those cash flows you get back, you could use operating profit metrics like EBITDA's, EBIT, and therefore EBITDA, EV/EBIT multiples are very often used in multiple valuations. And if you then deduct from your EBIT also interests, taxes, then you get net income and could calculate the PE multiple. We have here a little example of a typical multiples valuation. We have here peer group of, I think, 8 companies and 8 publicly listed companies. And in the first step, we basically retrieve the market cap, which is just stock price times outstanding shares from Capital Q, for example. Then we have to add our net debt, meaning debt less cash, and then we get our entity value. And that's important for the entity value multiples. So we have our market cap plus net debt is equal to entity values. And then we have here sales, EBITDA, EBIT figures, for example. And we could calculate EV sales, EV EBITDA, EV EBIT. If we want to calculate the price earnings multiple, then we only need the market cap and earnings. Yeah. And so we calculated for multiples here. And then we apply those 4 peer group multiples to our own company, to our own target company. And with, for example, reference values here for sales, we have here a sales figure of, I don't know if it's 1 million or 1 billion, something like that. And then we come up with an entity value of also 1 billion. And then we deduct our net debt and get our equity value. And basically, we do that also for EV/EBITDA, EV/EBIT multiples. For the price earnings multiple, it's a bit simpler. We only need our multiple and earnings and directly get our equity value. So we don't need here this bridge from entity to equity values. And what's important here is that if we talk about entity values, then we talk about a reference value which belongs to both equity and debt providers. And equity value directly only belongs to equity providers. So it's simpler in that we don't need this bridge. And the bridge I was talking about, we showed here a typical net debt bridge for you. Yeah, it's just so that you have seen that. You could go to the annual report, for example, of your company, and then you have to identify all the financial liabilities, the interest-bearing liabilities, basically. And all of those would go into your financial debt. So, for example, bank loans, pension liabilities, leasing liabilities, and sometimes we have also other debt-like items. And all of these liabilities go into your financial debt, your interest-bearing debt, and then you would deduct cash, excess cash in this case, meaning cash that you don't need for your operations. And if you have it, for example, in your company, then also like other financial assets which are not necessary for your operations. If you have, I don't know, if your company owns stocks in other companies, if other financial assets whatsoever, then you could also deduct that in your net debt if it's not necessary for operations. And that's basically a typical net debt bridge to go from the entity value down to your equity value. That's basically important for calculating peer group multiples and then also for calculating your own company's equity value if you use entity values. So if we use entity values, then we get entity values, and then we have to deduct all of the net debt. And we we put together here some pros and cons for these 4 most commonly used multiples. So 3 entity multiples and 1 equity multiple. And you could go through the pros and cons on your own. Maybe just one or two remarks. EV sales multiple is easy. Data is really easy to acquire, so that's really a pro and often used for startups, as mentioned before. And on the other hand, you don't really consider profitability, so it's really a big con for EV sales multiples, and that's basically the advantage of EV EBITDA or EV EBIT multiples, that you really account for profitability. And also for the EBITDA, EBITDA is really a rough estimate of operating cash flows. So it's basically your operating result before you deduct non-cash depreciation. So it's really a good estimate for operating cash flow. And for example, PE is also often used in practice, but in the PE multiple, you have sometimes quite high distortions due to accounting policies and taxes. For example, regarding accounting policy issues, sales figures are not that easy to manipulate. Sales figures is I wouldn't say it's not possible to manipulate them, but sales figures are quite stable in these terms. But if you then deduct your costs, you could, as a company, apply certain accounting policies that you report more cost or less costs. So your EBITDA is somehow could be affected. Your EBIT could be affected to a higher degree because you deduct depreciation, and depreciation is always subject to accounting policies. Do I write off my assets over 8 years, 10 years, whatsoever? So could be distorted. And with earnings, it's the distortion could be even higher because there you also have tax issues. Different country taxes in a multinational company, and so on, and also interests, that you pay more interest in 1 year, less interest the next year, whatsoever. So you could have some distortion here in order to really get a sustainable result, and that's really what we're looking for: sustainable figures for the multiples, because it's a one-period model. Okay, again, here we have some different kinds of multiples, and what's important here maybe is that we only discussed entity and equity multiples so far, but there are also a lot of other multiples, industry-specific multiples, for example, like subscriber multiples, where you measure your company value relative to the number of subscribers you have. For example, Netflix could do that. They have a certain they have a number of subscribers. They have a number of subscriptions outstanding, and they could measure their entity value or equity value relative to this figure if it's a value driver for them. And I guess, for example, for Netflix would be interesting because the number of subscriptions is really a key element of their business model. Or monthly average users, for example, could be also important for certain service providers. Or for asset managers, you have assets under management. And you could then measure your equity value relative to the assets under management, for example. And there are a lot of different multiples really out there. Yeah, so it's just keep that in mind. You will find a lot of different multiples. Yeah, and now I think we can go into more details.
Perfect, Lucas. Thank you so much. I just want to start with the place where you left off, meaning the other different multiples. So most of the time you look at financial multiples, which is EBITDA, revenue, and all the multiples Lucas just presented. And sometimes it's just very helpful, and there's no way around any other type of, let's call them operating multiples. And Lucas just briefly mentioned a few, but sometimes you need those multiples because with the traditional financial multiples, they're of no use for you. So, for example, when you think about a startup, right? I don't know, they are developing a platform and they don't have revenues yet, right? So it's hard to to make a multiple valuation based on an EBITDA revenue, EBITDA multiple when you have negative EBITDA, right? And then maybe you want to look at Netflix as a peer and you want to calculate the multiple based on subscribers. And then you can say, well, how much subscribers do we expect for the company? And then you have a value per one subscriber, and then you multiply this multiple by the number of subscribers you expect, and then you can start working towards a value. Of course, you have to make a lot of adjustments, but that's a better starting point than a a negative EBITDA. The other example would be a couple of years ago, I think it was 2 years ago or so, we helped a client with a transaction of one oil field. So it was an Austrian oil and gas firm, and they wanted to sell one of their oil fields. So not the entire company, but just one oil field. And then, of course, you can look at various multiples, but for one oil field, which has only a limited amount of oil reserves, you cannot just apply an EBITDA multiple, because in the end, what the EBITDA multiple assumes is that you have just one period. So you say that, well, the peers are showing an EBIT multiple of 10. But that assumes that the company will operate indefinitely, right? And with the oil field, you just have you have just oil reserves for, I don't know, a few more years, right? 5 more years or 10 more years. And so you don't want to apply an EBITDA of 10, because this would assume that you can operate the oil field indefinitely, and then you would definitely overpay. So one way of doing that would be to look at oil reserves, and then you calculate the value for 1 unit of oil reserve, right? Or oil reserves left. And then you can say, well, I have 100 barrel left in that oil field. And then you can again multiply the value of 1 barrel, right? So sometimes there's just no way around it. And sometimes it's just a very good shortcut to use the non-traditional, right? And of course, there are a couple of times they are very industry specific, right? So you will not find a reserve oil multiple in any other industry than oil and gas. Okay, so and then apart from the different types Lucas just presented, then there's another, let's say, category, I would say, which is trading versus transaction multiples. And what Lucas just presented is really which reference value do we use, whether we want to use EBITDA or price or the book value, or again, oil reserves. And here, when it comes to trading versus transaction, we're looking at where do we get the market prices from, right? So the multiple is basically market price divided by a reference value. Lucas showed you the different reference values, and we will now look at different sources for the market price. And there are basically two different sources. One is you look at stock prices, right? Then we're talking about trading multiples, and then you look at transaction prices, and then we're talking about transaction multiples. So let's go one by one. Starting with the trading multiples. Here you will look for the reference, so that the market prices based on the stock prices of the companies, right, or the share prices of the public company. So of course, here by definition you can only use public companies, meaning listed companies, right? Secondly, when you look at the share prices, you see that the share prices are based on numerous transactions, right? Multiple transactions, thousands of transactions each day, right? Giving you a sense of the current, well, market sentiment or market expectation regarding that very company, right? And secondly, not only are there thousands of transactions happening probably each second, I don't know, but the transactions are only concerned with, I don't know, one or two shares, right? So you have only minority, not so much minority shares, but really single numbers of shares that are transferred each and every single second, right? And that's totally different from the second, and we'll come to that in a second, but from the second category, which are transaction multiples, right? So they're inherently distinct from transaction multiples. And now, of course, not only do you have multiple transactions, only minority shares, but also various sellers and buyers, right? So all the transactions that are happening each and every single second, they are involving different sellers and buyers, right? And so you really have what you see, the stock price is the result of those transactions, right? Of those thousands of transactions, multiple buyers, multiple sellers, and they're only transferring a limited number of shares, right? So before we go into detail, let's contrast that to our transaction multiples. Well, with the transaction multiples, you look at one single transaction of a company, right? So one example would be Twitter, right? When you're looking at Twitter's current stock price, this is based on, and you calculate the trading multiple for Twitter, then this is really based on all the transaction happening for the Twitter stock, right? However, if Elon Musk will actually buy 100% in Twitter, right, then you have your transaction. And here you see that the big difference, right? With the stock price, you have all those different shareholders, all of those thousands of transactions. With the transaction multiple, you would only have Elon Musk buying Twitter for a certain share price, right? Or for a certain deal value, right? And here you have only one buyer, only one seller. You have a very particular situation in which the transaction happens, right? And so you have all the influencing factors on the price, because again, the multiple is only a result of the transaction, right? And of course, all the different, let's say, all the different motivations and rationales of the two parties involved will go into that and will determine the price, right? So the bargaining power, whether the buyer expects high synergies and so forth. So all this goes into the transaction. And here we not mostly are, but partly talking about transactions where you buy 100% of the stakes in the or 100% of the shares in the company, right? So you have a full takeover of the company, right? And of course, this is much different buying 100% of shares in the company compared to buying just one or two stocks of the company, right? And therefore, the results, and when you then think about all the different, let's say, frame for trading and transaction multiples, you can see that they're actually different, or that they can differ, right? So we just, or I alluded to it a little bit, when we talk about, or when we think about transaction multiples, and when you look at transaction that's happening, and where the buyer is actually buying the whole company, right? You can expect that within the price, there are certain synergies, or at least some expectations regarding synergies are included, right? Maybe there's a certain premium for having control over the company, because once you buy 100% of the company, you can actually control. You can, fire management. You can say that the company should go in a different strategic direction and so forth. So maybe you see that there are, um, there's a certain price premium paid for having control. And when you contrast this to trading multiples, you see that this is basically the opposite, right? So there's certainly no premium for control, because again, you're just buying one or two stocks in the company. And you definitely have no synergies, because you're buying just shares in a company rather than the entire company, right? So again, if you're buying the company, then you might say, well, I'm a strategic investor, right? I run the same business. I'm just buying you because you're a smaller competitor, and therefore I try to integrate you in my business, and therefore I can reduce administrative costs, or whatever, right? So with trading multiples, you don't have that, right? And this is important. And then when you think about all those, the potential control premium and the potential synergies, you see that the transaction multiples are expected to be a little bit higher than trading multiples, right? Because again, you expect some kind of control premium maybe, or some kind of synergy effect, right? And then, of course, I mean, on the positive side, the transaction multiples, you can look for public companies and private companies, because sometimes data providers such as merger markets or Capital IQ will have information on multiples for private companies as well, right? However, you have to be aware of the date of the transaction, because you can find a couple of transactions for very comparable companies, right? But if they are, let's say, 5 years ago, right, you might want to check whether the multiples are still representative of the today's market environment, right? Maybe there was some change in legislation, or maybe some change in customer awareness or customer preferences or something. So you might want just to double check. With the trading multiples, you can just look at the current stock prices and calculate the current trading multiples. So you know that that you have a current market environment. Okay. And just one quick note, all the different multiples Lucas just presented, meaning financial multiples, operating multiples, you can calculate for trading as well as transaction multiples. Okay. Any questions on those two concepts? Perfect. All right. Then I think we just talked about this. Yeah, I think we can move on to the next, let's say, categories, which is trailing versus forward multiples. And perfect. And we just talked about this a little bit, right? So to illustrate what we mean by trailing and by forward multiples, just let's imagine, let's take Twitter, right? Doesn't matter. So we calculate the trading multiples for Twitter, right? And we want to calculate the trading multiple for Twitter as of, let's say, 31st of December 2021, right? End of last year. So end of last year is today in this little picture here. And what you can do is you take the market cap for Twitter, right? You take the market cap as of 31st of December 2021. And then you say, well, I can take, for example, the EBITDA or let's say the earnings, the net income. I calculate the price earning, the PE multiple, and I can either take the net income from last year, which is 2021, or I can take the net income from next year, which is 2022, right? And the difference is the trailing multiple is based on 2021, which is you can call it a historical multiple if you want, right? And the forward multiple looks at the next year, the future, which are again forward multiples or future multiples. And you then say, well, for next year, I can take the net income, the PE multiple for 2022. I can also look at the estimate for the net income in 2023. So I can calculate my PE multiple for 2023, my expected PE multiple for 2023, and of course for 2024 and 2025 and so forth. What you use here, you use estimates for the reference values for revenue, estimated EBITDA, net income, and so forth. And what you so what we do, at least in practice, is of course we look at analyst forecasts, right? Financial analysts covering the companies. They sometimes present and disclose their forecasts or their estimates on the financials for the next year, the next 2 or 3 years. It's super uncommon to have outlooks or forecasts for more than 3 years. I think you find 3-year forecasts for the most or for the biggest companies. And for the smaller companies, you will find only a forecast for 1 year, meaning for this year, in our case, 2022, right? And of course, trailing multiples, you can calculate trading multiples for all the historicals you have, meaning for all based on the historical financials, net income of 2019, 18, 17, and so forth. Keep in mind that what you want to do is when you calculate historical multiples or trailing multiples, you use, for example, the net income for Twitter of 2018, right? And what you probably want to do is you take the market cap as of the end of 2018, right? You don't use the current market cap, right? The current stock price, but rather any historical market cap that correlates to the historical net income. Because the current market price, when you take the current market capitalization or the current stock price, all the current up-to-date new assumptions or expectations of the market is priced in, right? So take, for example, I don't know, take any company, and last year they finished or yeah, they concluded their patent and they developed a new cure for any kind of disease, right? Then of course today's market cap will include this breakthrough and all the revenue income expectations based on this new cure this new cure for the disease. But 2 years ago, they haven't reached that point, and so the market cap might look very different. And of course, the previous outlook looked very different. So just make sure that when you calculate trading multiples, you're not using today's market cap or stock prices, but rather historical prices which match the reference values, right? That's all we want to say here. And of course, when you then look, exactly, yeah, perfect. When you then look, we just talked about, or we just looked at the current trading multiples, right? The current multiple, here you take, for example, market cap as of December 2021. and the estimate for net income in 2022. So you have your expected PE multiple for 2022. But again, this only gives you one data point, right? And Twitter is a good example because maybe you want to argue that the current market price is totally distorted by Musk announcement to buy Twitter for a certain share price, right? So all the investors that are expecting Musk to actually buy Twitter will have a target price of exactly the announced deal value. So what you want to, and maybe therefore you want to check whether this multiple you are just currently observing is any kind of different than, let's say, historical PE multiples for Twitter. And so what you can do is, and this is a little bit the same with the beta factor, right? You just calculate one data point and you have one beta factor, and then you want to cross-check the reliability of that data point. And here, for example, what you see here is the historical development of the EV sales multiple, right? And here you say, here we have the current market price of the company and the expectation or the forecast for sales for the next 12 months. So for example, again, take December 2021, you calculate your EV sales for Twitter, and the EV sales for Twitter, the next 12 months are the revenues for in 2021, taking the current market the current market cap. And then you go back here, we calculated that I think on a quarterly basis, and then you go back and back and back and back in history or in time, and then you calculate, and then you look at the then current enterprise value and the then current forecast for sales, right? And here in this, and this is just an example, but what we wanted to show is that you have done a bigger picture of having a frame for the current price. And here in this picture, you see that, for example, the current EV sales is at 3.2, right, which is far right. And then you say, well, first of all, it's way above the average. The average is at 2.5. Now it's at 3.2. And what you also want to say is that, well, I see a certain upwards trend, right? So when I calculate the average of, I don't know, 2012 to 15, it's way lower than 15 to 2017, right? And so therefore maybe your interpretation or your conclusion on that picture is that the 3.2 is justified because in the end, it's just a result, or the latest stage in this upward trend. Maybe you want to argue that no, this is just a distortion, and it will reverse to the mean in any given time. But again, no matter what you make out of this picture, you have to first look at the picture to have all the data and really to assess the multiple, right? Again, it's just cross-checking the observations you make. All right. So so now I think we run through the different multiples. We had financial and operating multiples. We had trailing and forward multiples, and we had transaction and trading multiples, right? And this is just different ways of calculating multiples. And as you can imagine by now, what we would do when we run the multiple valuation, we would look at different multiples. We look at different peers, different sources, and again create a cloud of different data points, and then reach a conclusion on that. Here we have a different idea or a different perspective, which is we need to adjust the multiples we observe, right? And here we called it accounting for differences in growth and profitability. So I think we start with the profitability part because I think it's a little bit more easy to understand, and then we can go to the growth, but it's the same thing, right? So if you remember, I think Lucas just showed you how we would calculate the multiple from peer group, right? So we have different peers. We calculate the multiple for all the peers, and then we normally would use the average or the mean of that peer group, right? And again, when you look at the data a little bit closer, you might want to, make some adjustments to that logic or to that approach. And you don't want to just use the mean, right? And I will try to walk you through what we do here and why we want to adjust the multiples or the mean or the average of the peer group. So what we have here, we have 6 data points, which are the blue dots. And each data point represents one peer, and it represents the EV sales multiple and the EBITDA margin, right? So starting at the left lower corner or lower left corner, we have the first peer, which shows a EV sales multiple of 0.4, and then corresponding EBITDA margin of 20%. Okay. And each of the data points represents a different peer. And on the upper right corner, we have the other peer, so to say, the other company, which has an EV sales of roughly 0.1, right? Sorry, 1.0, and an EBIT margin of 50%, right? And I mean, this is, of course, an illustration, but this is the picture you see in real life as well. You clearly see that the higher the EBITDA margin, the higher the EV sales multiple, right? And so when you take the 6 peers and you just calculate the EV sales multiples for the peer group, and then you just take the average of the peer group, which is probably roughly around 0.8, you would use an EV sales multiple of 0.8, right? And you say, well, I'm done with that. I'm fine. However, imagine that your company that you're valuing has an EBITDA margin of 50%, right? Then you might say that, well, applying an EV sales multiple of 0.8 is just too low. You would undervalue the company, because a 0.8 multiple is just not representative for that level of margin, right? The reason for that is, imagine you have 2 companies, right? And both companies have a revenue of 100, and one company has a EBITDA margin of 20% and the other of 50%. Then you would clearly say that although they have the same revenue, you would expect the one company with the higher EBITDA margin to be more valuable, right? And this is exactly what we account here, because only by looking at EV sales, and Lucas mentioned this before, you're assuming that you have the same profitability, meaning you generate the same income, the same cash flow from one unit of sales. And if this is true for your peer group and your company, right? If all the peers have an EBIT margin of 20%, right? 90%, 20%, 23%, and your company is also in that range, well, then you don't have to adjust anything, because then the implicit assumption in the EV sales multiple is true for your peer group and your company. However, if this is not the case, I mean, given that you are convinced that this is the right peer group, but if this is not the case, then you might want to adjust and not take the average, right? Because and Lucas, maybe you can show that, but if you start with a company at let's say 25% EBITDA margin, right? You can look at the regression here and you can say, well, then an EV sales multiple of 0.5 is justified, right? And based on the data we have, a multiple of 0.5 is more reasonable to apply for a company with 25% EBITDA margin than the average, which is 0.8, right? And of course, it goes the different way as well. So when you say that your company has 50% EBITDA margin, then the data or the regression analysis will show you that, well, you should apply 1.1 EV sales multiple, right? And this is just because, and this is very important, I think, in business valuation in general, but specifically in when you're applying a multiple valuation. When you apply a multiple valuation, it's a very shortcut to your value, right? And there are certain underlying implicit assumptions in the multiple, and you just have to make sure that all those assumptions are true. And if not, then you might want to adjust your data, right? Any questions on the adjustments, or the adjustments for differences in profitability? So in practice, I think the adjustment for the differences in profitability, I think it's a very common thing to do, because again, I mean, in the end, your EV sales multiple just ignores the profitability entirely, and therefore you really want to make sure that you have a proper level of profitability in that. And you see, I mean, any statistician would look at this picture and throw it out the window, I guess, because we only have 6 data points, and you can't run any reliable regression with 6 data points. But I mean, we work with what we have, and therefore you can run rather reliably looking analyses on the EV sales side. And again, keep in mind, you want to do that, you want to adjust the multiple if you have differences between the peers and your company, especially in terms of the profitability. And the same picture you see for growth. So you would adjust your EV EBITDA multiple, right, for any differences in growth. Because when you're using a EBITDA multiple, or any profit multiple, right, EBITDA multiple, EBIT multiple, or PE multiple, you already factor in the level of profitability. So you don't have to adjust the EBITDA multiple for the EBITDA margin, because you're using the EBITDA, right? However, what you want to account for differences in growth, because again, you can imagine two companies, both are earning or both having a revenue of 100. One has an EBITDA of 20, the other of 50, and then you calculate the EBITDA multiple. However, the company, or sorry, a different example. You have two companies making the same EBITDA, right? Both companies have 50 in EBITDA, and you say, well, basically they're of the same value. However, if you have, for the first company, you have a growth outlook of 1% growth, and for the other of 10% growth, then you would assume that the other company is more valuable than the other, right? And you might say, well, we adjusted the EV sales multiple for profitability. That's fine. Don't we have to adjust the EV sales multiple also for growth expectations? Then I would say, yes, you do. But then you end up probably with having to perform a multiple regression analysis, and in practice you're you're fine with one variable. That's all you can handle with Excel. No, you can't. But in practice you account you make sure that you account for differences in profitability, because that's the real deal breaker, so to say. And if you then would account also for growth, then that would be fine, but that's just the cherry on top. I think, speaking from experience, the regression with the growth is a little bit more fuzzy. The regression with the EBITDA margin, you can probably it works probably every time, or 8 out of 10. With the growth, it's a little bit more difficult. But again, it's the same principle, it's the same tool set. And just keep in mind, you adjust your EBITDA multiple only for growth. You adjust the sales multiple for profitability and if possible, for growth. Right? And you don't have to use the regression only if there are huge differences between, or significant differences between, the peer group and your target. Any questions? Perfect. Then I think, Lucas, you want to go on?
Yeah, let's discuss some practical considerations. I think we discussed all the basics and also some adjustments you could use, and yeah, just some practical considerations. The first one would be to really, if you do a business valuation, then it's really important what concept or what value concept you use, or what you have to use. For example, in Austria, as you know from the previous guest lectures, we have a standard, a valuation standard, the KfS BW1, which basically provides guidelines for how professionals should come up with valuation. Yeah, how to perform a valuation, how to come up with certain valuation assumptions. And in the KfS BW1, for example, if you calculate a business value according to that, then the primary valuation approach is typically the DCF, according to the standard. If you, for example, look on other standards in Germany, you have, for example, the IDW. The IDW S1 would be more or less the equivalent of the KfS BW1, but you have also like a standard for fairness opinions there. And in the fairness opinion standard, there multiple valuations are equal, or multiples and DCF are equally weighted in your business valuation. And in other countries, for example, multiple valuations have a lot of more weight in valuations. Also in many investment banks, for example, sometimes only use multiples for valuation purposes. So it really depends on the country, on the legislation, and on the purpose of your valuation, which method you use. So that's very important, always to have the concept in mind. And for example, for the multiples, the complexity of the multiple valuation also depends on the objective, on the purpose of the valuation. If the multiples approach is the secondary approach, as it would be according to the KfS BW1, then you won't perform a very detailed, or you won't really go into each detail or every detail you could if it's only the secondary valuation approach. So if you only use multiples, on the other hand, then you would put more emphasis on really deriving proper multiples, adjusting them properly, and so on. So it really depends on what you want to do, what you have to do. Always important to look at what multiples are best to use, for example, and your equity multiples. For banks, for example, for financial institutions, you would only or you could only calculate equity value multiples, because for a bank, entity values don't really exist. Also, what's important, is your company, your valuation object, is it a listed company? Do you need a peer group, for example? And then you could calculate, multiples for your company, for the peer group, or you take industry multiples, for example. Professor Demodaran publishes industry multiples. I think each year he basically calculates multiples for each industry for at least EV sales, EV EBITDA, EV EBIT, and PE multiples, I think. And so always keep that in mind. What is the source for my multiples? If you use a peer group, maybe you need to check again the peer group. Is it consistent? Is it comparable to your company, and so on? So we have a lot of questions here, and you shouldn't be intimidated by that. It's just more to actually to give multiples more meaning, or more weight, because if you think about all of these questions and come up with reasonable solutions, then a multiples valuation could be preferable, for example, to a DCF valuation, if you really go into the details and analyze it properly.
And maybe just to add to that, when you think about this, right, the multiples are always presented as a shortcut for valuation. You just take, some comparable companies, calculate the multiple, and then you multiply this multiple with your revenue or your EBITDA. But when you really think about this, all the different steps you have to take and all the things you have to make sure and look for, you basically end up with not only performing one valuation for your target, but a couple of valuations for the companies themselves. Because you take, for example, a peer group of 5, and you calculate the EBITDA, the trading multiples, right? So you start with trading multiples. You want to look at the reference values, make sure that the reference values are representative and not distorted by any one-offs or anything like that. You then look at their stock prices. You want to make sure that they are not distorted by any, Lucas mentioned it, any market sentiments, bubbles, or whatever. Then you don't look at one data point for all the peers, but really rather, historicals or forecasts. And then, of course, you look at whether you have differences in profitability and so forth. And then what's left is then you have to come up with a good estimate of your sustainable reference value for the company, meaning your EBITDA, for example, right? Only taking the last year's EBITDA might not suffice for a proper multiple valuation. So sometimes you perform an entire financial due diligence in order to come up with a proper sustainable EBITDA for your company, which you then use for the multiple valuation and for the price negotiations, right? So all I'm trying to say is that it's a very useful tool, and as Lucas mentioned it, for us, it's a secondary evaluation method. But you have to. It's more time consuming. It's more tricky than you might think. That's all.
Mm. Of course. Could be a very simple valuation with multiples. Could be very complex also. So really depends on what you want to do or what you have to do. As Robert mentioned before, sometimes you have to perform a due diligence for deriving a sustainable EBITDA, for example. We have here a little example of how to use a due diligence report, for example, as a first starting point or primary source for your multiple valuation. But I think you can go through that on your own. It's basically just as a source that you could use the due diligence report, which is often performed in a transaction for a first valuation for this transaction. So that we just use the EBITDA, for example, from the due diligence report and multiply it with EBITDA multiples and come up with equity values in the end. But what's more important for the case study, I would emphasize is that in the end, if you performed all of your different valuations using different valuation techniques, different approaches, in the end, you want to really show your results. And what we do often when we are in a report, for example, or if we want to show the client the valuation results only, then we typically show a picture like that, a so-called football field, where we basically show all the different valuation methods we used. For example, in this case, we used the DCF valuation. Our company is publicly listed, so we also have a share price to compare it to. And we also have trading and transaction multiples, for example. And what we will what we don't do is really to have a range from minimum to maximum over all the different valuation methods. Instead, we would really show each valuation method and different values. And in the best case, all of the different valuation methods come to more or less the same value or the same conclusion. For example, in this case, we have here DCF value. This orange line is the point estimate of our DCF value. So let's say the management case. And then we performed certain sensitivity scenario analyses. We showed you that in the business plan session, where we vary certain value drivers and so on, certain assumptions, and then we come up with a value range. And then the second thing here is share price. For example, here we have the last 12 months share price and the last 24 months, just as a reference. You could also calculate for the past 3 years, value weighted average share prices and so on. So this is just a good comparison. If you have a share price, and you all do for the case study, then it's always good to compare your value conclusion, your DCF result, for example, with the share price. And also we calculated here trading multiples, adjusted EV sales multiples, adjusted using the adjustment approach Robert showed you before, and also EBIT multiples for both trading and transactions. And here, for example, you see that transaction multiples show higher results. That's also quite typical because often in transactions, the buyer pays too much. He pays a premium. Sometimes it's referred to as a controlled premium. Sometimes it's just that the seller is a good negotiator, and so the buyer overpays is a typical picture, and then transaction multiples also show higher results than trading multiples. It's very common. And if you then show such a football field in the report, in your case study, then it's very easy to have all the results of your different methods in one picture. And really, you can only discuss then this one picture for sometimes we discuss it for 20 minutes, half an hour, only this picture, and what's all different results mean, and what's then our conclusion, basically. If that, for example, the DCF result is plausible compared to other valuation techniques. Because if we perform a KFS BW1 valuation, then we have to assess the plausibility of the DCF valuation result. And for that, we use, for example, multiples, share prices, and yeah. So then we really need this picture. And in practice, you will find that in a lot of valuation reports by investment banks, by analysts, and so on. So very typical, very common picture.
Maybe just to add to that, I totally agree, and it's a very useful tool. And when you think about your presentation, it's interesting because you can either finish with that overview. So you start with, for example, the share price. You have the chart. You draw your lines, and then you say, well, that's the average of the last 12 months or 24 months. Then you show your DCF valuation on one page, right? You show the cash flows, the present values, and the terminal value, and then you just describe your main assumptions, meaning the EBITDA margin in the terminal value and so forth, and then you present your multiples, and then you end up with that picture. And then, as Lucas mentioned, you just talk and talk and talk about this picture, or you can even flip it and start with that picture, right? And just start by saying, well, we performed the DCF. The DCF shows a value range between this and that, and we just cross-checked our results with a bunch of different other methods. And then you just focus on your DCF, and then you make a deep dive into the DCF or the multiples, whatever. But as Lucas mentioned, it's a very useful tool, and it really keeps the conversation going, I guess.
And yeah, I think that's it. We have 5 minutes left. Robert, if you want, we can show a report very briefly, go through a typical valuation report.
Sure. I mean, if there aren't any other question, we can use the 5 minutes on the report, or we discuss any questions. But since no one raised their hand, I think the report is a good idea.
Yeah. Do you want to share it? Should I?
If you can share it, that would be perfect, and then I just can just speak a little to it. So I guess it's an example report, I guess, what we have. So we just wanted to give you an insight of how the end result, our product, so to say, would look like. Here you keep in mind that the report you're about to see, no, but the report is a very technical. There are different reasons why we perform the evaluations, and the methods are basically all the same, right? We use multiples, we use DCF, and so forth. But the end result is so different. So, for example, what we wanted to show here is a very classic report. We do that for, I don't know, tax authorities, or or something of that sort. When we, for example, advise our clients in a transaction, and we advise our clients on whether to buy or not to buy, so a sales buy-side engagement, we probably have only one slide, the football field, and it's quite colorful, and we have some graphs and so forth, because we present to the management or to the board of the company. Here you see a report which goes to any kind of tax authority, right? Sometimes we perform valuations for legal reasons. Then you have a 200-page document with references to any kind of legal disputes and so forth, right? So it's the result, the end result is so different, but the methods and the approach are always the same. We ask what is the potential of the company to generate revenue or in profits, and then we calculate the present value. So here we start. I mean, we can skip that. I think this is just a formal slides where we say what we do. Here, I think the table of content is quite interesting because it gives you a sense of what we do and what we consider as important for the valuation, right? I think that's what I'm trying to say here, because in the end we start with the background. So of course executive summary, but we start with the background. So we give the reader the information of why we performed the valuation, what is the valuation date, what is the valuation object, what is our evaluation approach, so that he or she really has the frame of reference, because again it can differ and it has an impact on the valuation. Then we start with the market environment, and coming from a very broad view, but the macroeconomic environment, the market environment, we show some competitors, right? And here we try to establish some facts, some data, and all the information we present here has to be somehow used in the valuation, right? Because if we present any information that's nice to have, but it doesn't really is of importance for the valuation, then we wouldn't present the information, because why doing it anyways? So here we have market data and competition. Then we start with the company, so we narrow the focus, so to say. So we look at the company, we present what you did basically in the first session, which is the business model analysis, right? Here we present what are the products, what are the markets, what is the value chain, and what are the most important assets for the company. Because again, this is important. And then, of course, the second step would be the financial analysis, right? So we look at historical financials. We look at historical financials. We look at the revenue growth, the EBIT margin, and so forth. We try to explain why um, the the revenue increased or decreased, why the margins decreased, and so forth, right? And then third part would be the business plan analysis, and this is what was your second session basically. And this is important. Based on the market analysis and based on the company analysis, we are then, let's say, able to present and assess the business plan, right? So in our case, we oftentimes get the business plan from management, right? Because they prepare a budget or a multi-year business plan. We do not have to develop our own business plan, but the I think the job is the same, right? We get presented with the business plan, and then we have to do the plausibility assessment, whether to assess whether the business plan makes sense or not. And therefore, again, we look at competitors, we look at the historical development of the company, we look at the market, and so forth. And then only then we start with the valuation, right? So we outline our approach, in this case our DCF. We estimate the cash flows based on the business plan. We estimate the discount rate. This is what your third and last session was about. We present all the market data and present in our case the WACC. We present the net debt, right? And then it all comes together, and we present the valuation results. And in the end, we perform a sensitivity and a plausibility assessment, right? And I don't know, Lucas, maybe just a few slides to give you a look and feel. Maybe we jump to the market environment, because I think there you can see some. Yeah, so here we present the analysis and of course the conclusion for the analysis, right? It's always you present the data, you note the source of the data, and then you present your conclusion on the data, right? And you try to make sure that the illustration or the graphs you use really supports the message you want to bring across, right? That's the thing you want to do. And here, for example, you see that, for example, in the left box, we noted the median or average profitability and the median and average growth rate, and this should come in handy at a later stage where we assess the EBITDA margin of the company, for example, and we say, well, the company has shown a historical average of 15%. The peer group shows a median of 16.7%. And in the business plan, they assume 18%, right? And therefore, we consider it plausible, something like that. Then maybe this is a traditional way of presenting it, which is we show the income statement and then we have some kind of remarks on the material accounts. The same with the balance sheet. So we present the historical balance sheet and then we, have some remarks on it. We have the cash flow statement as well. So working capital. So here's a deep dive into some aspects which are most important, and then of course we come to the business plan, and here again we we present the business plan. In this case, it was only it wasn't an integrated but really sales to EBIT business plan, and then we present the underlying assumptions based on information from management. And then, of course, we have to assess again the business plan and whether it makes sense. Here you, for example, perfect. And then evaluation. I think that's interesting maybe for you to see. We start with the cash flow. So we present the cash flow analysis, and what cash flows we use for the evaluation. Then we present the cost of capital. Again, the table looks a little bit the same as in the template, Excel template. And then I think, analyze the net debt. And here it is always, again, it's a very technical report, but the idea is really we present the data, we present what we did with the data and why we did it, and then of course the results, right? And maybe we have the football field anywhere. I hope at least.
Yeah.
Oh no.
Here.
Here you see. And here you see the football field, meaning the DCF, the EV sales and EBITDA. Here we presented it for trading multiples and transaction multiples. And of course, in the appendix, you will find all the necessary or underlying data, a lot of tables and graphs. And yeah. Perfect. Alrighty. I think we're at the end. So I think this was the last guest lecture. We have only one coaching session left. We will send out the MS Teams invitations as usual. We'll send them out today. In the next coaching session, you can present your results or your preliminary results on the DCF. You can present your preliminary results on the multiple. You can ask any other overall questions or anything like that. And then after that session, we will send out a short email outlining the presentation day, right? So we will just outline what you have to do, how it will be structured, and so forth. And of course, you can after that you can write us an email if anything isn't clear enough. Just feel free to reach out to us. Last but not least, and I think I speak for Lucas and me. We really enjoyed the guest lectures with you. We really hope, and this was our intention, that it was interesting for you, that we could show you at least a little insight into how you would perform evaluation from a practical point of view, right? I think you saw that there's no one way of doing it, but that it is a lot about, collecting data, financial data, market data, and so forth, and trying to make sense of the data. This is at least what we do here. I hope you enjoyed it. I hope it was helpful. I hope the coaching sessions and the guest lectures were helpful and interesting for you. I hope you like or enjoy at least a little bit working on the case studies. this would be perfect. Last but not least, if you enjoyed the classes, right? If you enjoy finance and valuation, and you're thinking about an internship or anything like that, you're welcome to reach out to us. We have internships. We have fixed graduate jobs. We also supervise master thesis. So the thesis will be then tightly connected to any valuation topic we have here in our day-to-day business. And yeah, I mean, as always, you can drop us an email at any time. Yeah, we just wanted to thank you for attending all the classes and the sessions, and we hope you enjoyed it.
Thank you. Thank you very much.
Thank you.
Perfect. Thank you.
Thank you.
Thank you so much.
Have a nice
Thank
day.
you.
Thank you very
Bye.
much. Bye.
Goodbye.
Ciao, goodbye.